Welcome back to Talk Tickers. It is Thursday, February 5th, 2026. And if you are looking at your screen this morning, you're probably seeing a lot of red, especially if you're holding Varonis Systems. Ticker is VRNS.
Oh, yeah.
They dropped their Q4 2025 results last night. And, I mean, the reaction has been just violent.
Violent is the right word. It is a bloodbath out there for Varonis holders. We're seeing the stock down, over 10%?
At least. It went from around the mid-26s all the way down to about 23.80.
And, it's one of those really fascinating situations because if you just glance at the headline numbers, they look good.
They look great.
A beat on revenue, a beat on earnings. You'd be scratching your head wondering why the market is just tossing this thing in the bin.
Oh, that's the classic setup, right? A beat and drop. It almost always means the guidance is ugly or there's some kind of, structural problem hidden away in the details.
And there is. It really is a tale of two companies. You've got the old Varonis, the on-premise software, the cash cow, and then you have this new SaaS-only company they're trying to become.
And the birth is painful.
Very painful. Management is, they're ripping the bandage off. They've announced a forced end of life for the old software. They're burning the ships.
Burn the ships is a great line for a general, but it makes investors a little nervous. So before we get into that huge strategic gamble, let's just ground ourselves in the numbers. What did they actually report?
Sure. So looking backwards, Q4 2025, they delivered.
Yeah.
Revenue was $173.4 million.
Okay.
That beat consensus by about 4.7 million. It's up almost 9% year over year. Okay. So sales are happening.
And on the bottom line?
Non-GAAP EPS was 8 cents. The street was only looking for 3. So, a huge beat there.
Okay, stop right there. Non-GAAP is doing a lot of heavy lifting in that sentence.
It is.
Whenever I see spread like that, I have to ask about the GAAP number. What was the actual loss?
The actual loss was 13 cents per share. But the number that really, really caught my eye was the gross margin.
I saw that.
It fell to 80%, just 80% flat. A year ago, that was 84.4%.
That's a 400 basis point drop for a software company, that is. That is painful. People love software for those sky-high margins.
Right. And it really just speaks to the difference in the models. In the old days, they sent you a license key. You paid for the servers, the electricity, everything.
Their cost was almost zero.
Exactly. Now, Varonis is hosting it all. They're paying the Amazon bills, the Microsoft Azure bills, and that just eats into your margins.
Yeah, and 80% it's getting close to that danger zone. You drop into the 70s, and the market stops treating you like a tech darling.
But management doesn't want you looking there. They want you looking at their new favorite metric.
Of course they do.
SaaS annualized recurring revenue. And by that measure, I mean the transformation looks pretty good. SaaS AR is now $638.5 million.
So that's what, 86% of the total business?
86%. And here's the kicker. If you strip out the customers who just converted from the old stuff, the organic growth was 32%.
32%. I mean, if this were a brand new company with no baggage, investors would be lining up for a piece of that.
Right. But it's not a startup. It has baggage. Yeah. And that baggage is why the stock is getting hammered.
So let's talk about that. The end-of-life strategy. They basically told customers, move to the cloud or else. How'd that go in Q4?
Well, as a shock tactic, it worked. They had a record quarter for conversions. $65 million worth of business moved over.
The CEO, Yaki Fatelson, had this great analogy on the call. He said the on-prem software is like a bicycle, and the SaaS platform is a self-driving car.
It's a clever analogy.
It is. With the bike, you do the work. With the car, you just sit back.
But it kind of hides the friction, doesn't it? Because now that they've converted all the easy ones, the willing customers, they're hitting a wall.
The stubborn cohort.
The stubborn cohort. And you can probably guess who that is.
Let me guess. Government.
Federal and state governments. The Fed shed, as some people are calling it. There's about $105 million of that old ARR left. Management was pretty blunt. They only think 50 to 75 million of that is going to convert this year.
Wait. Let's do the math on that. 105 million is on the books. Best case, 75 converts. That leaves 30 million just gone.
Gone, or at least at risk of being gone. These government clients are just slow. They have rigid budgets, security clearances, and frankly, they don't like paying a premium for SaaS.
So Varonis admitted this is going to hurt.
Oh, yeah. They said this whole decision creates a $30 to $50 million headwind to free cash flow in 2026.
That's the sound of investors hitting the sell button. A $30 to $50 million hole in your cash flow.
It's a valley of death in the financials. And to try and explain it away, management started doing something that always, always makes me nervous.
The metric gymnastics.
The metric gymnastics. The analysts on the call sounded pretty annoyed.
So what's the new magic number they want us to look at?
Get this. SAN ARR growth, excluding conversions.
Excluding. So they want us to look at their growth, but ignore all the customers who are leaving.
Precisely. They're guiding to 18 to 20% growth on that specific metric.
That feels like cheating.
It kind of is. Because if you look at the total business, the actual exit rate for ARR, it's growing at maybe 10%.
It's like having a bucket with a hole in it and saying, hey, look how fast I'm pouring water in. Just ignore the puddle on the floor.
The market sees right through that. But here's the part that I think is the most important piece of the whole story. To hit that 18 to 20%, they completely rewired their sales team's compensation.
The sales incentives, this is a massive culture change.
Total game changer. Last year, a Varonis sales rep could make their number just by calling existing clients and getting them to sign the migration paperwork. Easy money.
It was farming.
Pure farming. Now, the farm is closed. In 2026, you get zero credit. Zero. For a conversion.
Wow.
You only get paid on net new logos or a big upsell.
So you wake up on January 1st and your whole playbook is useless. You have to go out and become a hunter.
You have to become a hunter. And that creates desperation. I mean, it's a huge gamble. You're forcing your team to hunt, but what if the prey isn't there?
So why do it? Why create all this pain? The stock drop, angry government clients, a stressed out sales force. There has to be a product reason.
And the reason is AI. It's all about the speed of AI attacks. Yaki had this great line. He said, attackers aren't hacking computers anymore. They're hacking trust.
Okay, what does that mean in practice? Why does hacking trust require a SaaS product?
It's all about reaction time. An AI agent can get into a network, find the crown jewels, and get out in minutes, not days, minutes.
So your on-premise server that updates its virus definitions once a day is just, it's useless.
It's bringing a knife to a drone strike. Varonis is saying the only way to defend against this is with MDDR-managed data detection and response. And that has to be in the cloud, constantly learning, powered by their own AI.
And this is where the Ultra acquisition fits in.
Exactly. Ultra is all about giving visibility into what AI agents are doing. It watches the watchers. You can't deploy that kind of tech to thousands of different on-prem servers. You need everyone on one platform.
They gave that hospital example on the call.
Yeah, that was the mic drop moment.
Yeah.
A 45,000 employee hospital system, they thought they were secure.
Right.
Varonis plugs in their SaaS platform and boom, finds 500,000 instances of exposed HIPAA data.
500,000, that's a company killing breach right there. The fines alone.
And the native cloud tools missed it. But Varonis didn't just find it. Their platform auto-remediated it, locked it down. That's the self-driving car pitch in action.
So the tech story is strong, the thesis is sound, but the stock is still getting crushed. So it really is just the market hating this transition year.
The market is stuck on the rule of 40. You know, growth rate plus profit margin should be 40 or higher.
And right now, Varonis is nowhere near that. If total growth is 10% and margins are getting squeezed...
They're a rule of 25 company right now, and Wall Street punishes those. The market is pricing in the absolute worst case.
They're saying, call us in 2027 when the messy part is over.
Which is exactly where an opportunity might be hiding.
That sounds like a perfect segue. We've picked apart the mess, now let's look for the opportunity. It is time for our This Is Not Financial Advice segment. And we have to say it, we are not advisors. This is for entertainment. Do your own homework. Do not sue us. Okay, you've got a trade. The Fed shed leap. Lay it on me.
I do. The Fed shed leap option play. Here's the logic. The market has completely over-rotated on the fear of losing these government clients.
The Fed shed?
The Fed shed. The guidance feels sandbagged. They're setting a low bar, but everyone is forgetting about the other side of the equation.
The sales reps.
The hungry, hungry sales reps. These people have mortgages to pay. Their easy commission checks are gone. You have no choice. Absolutely no choice but to go out and aggressively hunt new commercial business with this hot new AI security story.
So you're betting the new logo growth is going to be the big surprise.
I think it's going to be huge. So here's the trade. Buy deep out-of-the-money call options for January 2027.
So you're giving it time.
You need to give it time. Give that sales team 6-9 months to get rolling. The catalyst will be the Q3 earnings report later this year.
And what happens then?
By then, that metric everyone hates today, SaaS ARX conversions, it's going to be blowing past that 20% guide because the sales team has no other way to get paid.
And when that happens, the whole story flips.
The narrative flips from dying legacy business to hyper-growth AI security play. The Fed shed will be forgotten. The market will start looking ahead to a clean 2027, and the stock could easily rip back into the 30s.
I have to admit, I like it. It's contrarian. It's a bet on human nature, specifically a salesperson's nature.
It's risky. If they can't land the new logos, the stock is dead money for a while. But after a 10% drop, I think the risk-reward is compelling.
Okay, let's wrap this up. Give us the final summary.
Varonis is walking through the valley of death. They're killing their old business to build a new, better one. 2026 is going to be ugly and full of confusing numbers. Cash flow is getting hit. But the destination in 2027 looks really, really good.
And the one metric to watch, the one number that tells us if the plan is working.
Ignore almost everything else for a moment. Just watch the new customer intake in Q1 and Q2. If that number is soft, the hunters are failing. But if that number is strong, even with the government churn,
Then this dip was a gift.
this dip was a gift.
The Valley of Death or the Trade of the Year. We'll be watching. Thanks for tuning in to Talk Tickers. Keep your eyes on the screen, and we will catch you on the next deep dive.